Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in today's video I'm going to go over one of the companies. One of the brothers have requested to check out. That company is Nucor Corporation. This is a Dividend King company. One of the brothers have asked me to look at it, so that's exactly what we're going to do. Before we do that, I would really genuinely appreciate if you can join us in the Patreon account, where you get access to a lot of things, and the money that you basically pay for is actually helps me to actually do subscription for and a lot of the stocks basically and the software that we use on a daily basis. So that will be absolutely amazing. The company we're going to talk about today, like I said, in Nucor Corporation. This is a Dividend King. What we want to do now, understand what the business model is. We're going to try and understand the financials behind this company. We'll look at the discounted cash flow models and all of these things at the end, and I'll tell you exactly what I would be doing moving forward about this company. We haven't really spoken about this company much. A year to date is down 32%. For the 1 year is down 34%, and it's heading basically towards the $113 per share, which is the 52-week range, the lowest it's been for the for the last 52 weeks. The highest it's been is $103 per share, so it has come down quite a bit. But there is one catalyst for this company maybe doing well moving forward, and that is this article that I just found on here, Seeking Alpha, where they talked about because of Trump election and what basically Trump has done the last time he was around. Remember, he basically put a tariff of 25% of basically imported steel from all these other countries. So because of that, they have to basically this company did really well. But of course, that was the World Trade Organization had said basically at the time the tariffs broke global trade rules. So I don't know if if he will do exactly the same thing again. But because of that, these stocks actually went up, including the X, which is basically the ETF that tracks the whole steel companies in the S&P 500. So because Trump getting elected, this could actually be a massive thing, basically help for this type of companies. But again, anything can happen. You do not want to be relying on Donald Trump. Basically, the fact that 1 minute he's talking about imposing some tariffs on, still the next minute could be something else. So you just have to basically really think about that. Okay, and just don't invest just because of that, just one thing. Right, so a year to date, we've already seen the stocks down about 33%, but this X, which is the still an ETF that tracks, is almost identical. Okay, and one of the things that I've also noticed is because of this type of commodity companies, they actually also track more or less the price of the commodity they track, which is quite interesting. So for example, iron ore, if you check the price of Rio Tinto and check iron ore prices, more or less the same. So this company will probably be the same. So for the 1 year, as you can see, it has actually gone down quite a lot. So maybe there's some underlying situation there. So it will be interesting to see moving forward in terms of what this company does moving forward. The other thing I've noticed is the years where, so for example, 2021, I'll show you in a second. 2021 was the highest that it's been over the last 10 years, right? The price of steel. Now, if we go on here and go to financials, what you would see 2021 here, okay, look at the revenue, $36 billion, and 2022 was $41 billion. So probably because a lot of it was basically they've done really well in 2021 and 2022. For that reason, basically these 2 years were very, very profitable, but the following year is actually down quite a lot. One of the things that you will notice about this company is very cyclical. Again, if you do the same thing with Rio Tinto, you will find it. In fact, let's have a look at the Rio Tinto revenue. Okay, $47 billion to 34, 31, 40, 40.5, 43, 44. So it's stabilized around here. Then it jumped to 2021, $63 billion in 2021. Okay, probably look at the price of iron ore. In fact, let's do that. Let's check iron ore price in 2021 and where it was. So let's go back last 5 years, and the year that we look at that, in 2021 the price of iron ore was so ridiculously crazy. Look at this stock, okay, $63 billion, and then it has come down a bit quite a lot, $55 billion, $54 billion, $54 billion. So that's something that I've noticed with these type of businesses, and something that you really need to take into consideration. So now going back to New York Corporation, but the other thing you also need to worry about is this here, the cost of that revenue. They're spending a lot of money making that, basically $31 billion. So $26.4 billion to make $31 billion. And basically their gross profit very, very low in comparison to how much they've made, let's call it $5 billion. Then of course they've got some sales administration side of things. They've got some taxes they need to pay. Their take home is $2.5 billion. That's quite low for me, to be honest with you. The other thing we need to check also is the debt levels. Okay, so this is the type of business that has a lot of debt, or maybe let's look at the current assets. So current $13.5 billion and the total asset of $34 billion. Current liabilities $5 billion. Okay, so they got enough. They've got way more than enough to actually cover that, and in total liabilities is only 12.7, total assets of 34. That's really good. Okay, I like that. That's really good. Their total debt is not that bad either. Okay, $6.9 billion of debt level right now. That's really good. Okay, so solid so far. Let's have a look at a bit more information about the company now. Now, it has a narrow economic mode. Current price $117 per share. EPS of over just $10. And the beta is actually could be slightly high. Now, the current PE is about 11. The forward PE is about 14. The 5-year average is 12. So the current PE is in between. So it's basically slightly lower than basically the 5-year average and the forward PE, which is interesting. Okay, so the sector median is about 19. So based on PE ratio right now, it seems very cheap. But again, a lot of these sectors, the sector normally does have a slightly lower PE, so it's interesting. Annual dividend, we're looking about almost 2%. The payout ratio only 20%, which is really good. This type of businesses normally they have a very high payout ratio, so I like the fact that this is very low. The annual payout, you get $2.20, the 5-year growth rate of 6%, and dividend streaks of basically 50 years. So they just became a dividend king. Dividend safety of 90% from Simply Safe Dividend. Free cash flow $1.7 billion. Free cash flow compounded annual growth rate for the last 5 years, we're looking at about 7%. And the free cash flow margin of 6%. Normally we're looking for anything about 10, but that's absolutely fine. Profit margin 8%. Operating margin of 11%, return on equity 12%, return on invested capital about 12%. So nothing to scream about, but it's decent. It's okay. The net income, we're looking about 12% for the last 5 years, and then total return the last 10 years we're looking about almost 11%, which is very, very good for this type of business. Revenue growth for the compound annual growth rate of 10%. The EPS is basically about 3%, and current ratio, we've already seen they have a more current assets than current liabilities, which was quite good. Now they're expecting the growth. This is where I have problem with this company. Look at the growth expectation for the next year when it comes to revenue side of it, only 2%, and the EPS growth is about 3%. So if we go back here, okay, let me quickly show you where that information comes from. And we look at 2024 is already done. 2025 is about just 3%, 2.8 when it comes to year-over-year growth when it comes to EPS, okay? And then the following year, they're expecting about 42%, 43%, and there are 8 analysts looking at it. So it is getting better, okay, massive. So I don't know if that's organic growth or if they acquired another business or there's expectation that deal to go through. Will be interesting to dig deeper. And this is what I would be doing if I was really interested in this business. If I were you, I would definitely start looking at it. Are they acquiring another business? Why is this massive growth? Where is that coming from? Okay, and then you've got the EPS. We've already seen this year has been declined 1.66 when it comes to revenue next year, then 7.5% the following year. That's, to be honest with you, that's not a huge $31 billion to $33.3 billion, and there are 10 analysts looking at this. So it will be interesting to see where the massive EPS growth is coming from. But regardless, it is 3% for the next year. So according to Morningstar, they're saying about 20%, 27% discounted right now, $159 per share. According to Simply Wall Street, it's about 11-12% undervalued at the moment. $133 per share is where they think the price should be. 177 when it comes to tip rank, and when it comes to average price from Seeking Alpha is $163 per share. So all of them kind of agree that it's undervalued at the moment, and I do think it is undervalued, but this is the bit that worries me about the growth. But the fact that there is something coming up, potentially that 40-something% growth EPS, that is interesting to know. In terms of Sharia compliance side of things, nothing to worry about. 20% when it comes to interest-bearing debt, and interest-bearing securities is about 14%. As you can see here, free cash flow grew from 1.1 to 4.6 to then 8.2, then 4.8, then it has declined to 1.7, which is basically around where we are now. And they are buying back their own shares, which is interesting as well, because you want to see these companies buying back their own shares year after year. So overall, it is okay company. You're not getting massive growth right now. It seems cheap enough. So this is the type of value investors kind of company, because you're not getting massive growth. You basically sleep well at night kind of company. You're getting the dividends, basically 2% almost dividend every year. On top of that, it's actually growing, and the payout ratio is quite low. They do have some free cash flow, of course. And yeah, so it is a decent company. It's probably one of those foundational companies that will probably put about 2 to 3% of my entire portfolio, nothing more than that. I do own some of those companies. One of those is Rio Tinto. For me, it is the dividend yield, is that income that comes from the business, and now is a very cyclical business, okay, but it is important. So Rio Tinto, when you look at the dividends, okay, it is quite attractive. I don't know what's going on with Seeking Alpha today. It's a bit slow. It is quite attractive, okay, and of course there's not much information these guys don't have, but look at that, almost basically 7.3% when it comes to that dividend yield. So overall, it's a great company, but I would not be paid for higher prices right now. It seems very cheap, so it is fine. Overall, Morningstar valuation, Seeking Alpha, Simply Wall Street, dividend discount model that I used, multiples valuation, all of that average out, you get $152 per share of intrinsic value for this business. Right now it's $117 per share. That's about 30% downside and upside from where we are. Margin of safety, even if you put 30%, you can buy it today. So even if you say, you know what, still companies are very cyclical business, I will buy this stock $121 per share. That's still below where we are right now. So overall, great company. I really like it. I don't think there is a massive risk in this type of business, but of course you have to take into consideration the fact that basically these commodities can go up and down, and these companies trade whatever, and it depends on a lot of things. And if Donald Trump decides to put tariff on these companies, then because they are US based, of course a lot of the companies in the US will then have to pay higher prices to get it from somewhere else. So they will have to pay basically higher premiums for new corporations, basically stock. There are other companies, Cleveland Clins. I think this one, Clivs, is actually not Sharia compliant, but there are other companies within the steel sector that are also potentially benefiting from this. Anyway, I'm going to stop the video here. I hope you're enjoying this type of content. If you are, please join us in the Patreon account. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.